All right, let's get her started. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. I got out of Shop, I got out of Microsoft, I got out of Exxon. I guess Exxon was just a day trade, and I guess Microsoft was just a day trade again today too. I was able to make a couple bucks in each, but nothing to write home about. Just a little bit. Yeah, I mean, tough day. Downtrend day today. SPYs closed down 1.5%. Qs closed down 1.4. IWM closed down 1.9. Going over to the 5-minute chart. I mean, it was really a story of the Fed members just sinking this market today. I think we had, what's that Fed member's name? Muster or something like that, speaking at around 10 a.m. There's no direct downtick there, but this is when Bullard was speaking. That one's very obvious. And then I think we had Fed member Williams speaking into this downtick. So really just seemed like today was a day of Fed members yapping and bringing the market down, which we know is their motivation. They want this market down to try to help keep inflation down, and that's what we've been expecting. I said this going back to the CPI day here on November 10th, that one thing that we can be assured of is even though this market is now in a much better condition because of this candle, it's in a better condition both technically and albeit briefly fundamentally, we can expect that whenever the Fed members are going to speak, they're going to be using that hawkish language. Because whenever the market's going up, they're using that hawkish language to try to hold it down. And whenever they think that the market is down too much and they're worried about a hard landing, then they start using language that becomes a little bit more dovish. And the language here, since that CPI number has been really consistent, it's been hawkish. I even remember on the CPI day that morning, I think it was Bullard. I'm not 100% sure, but I think it was Bullard. The CPI came out at 8:30, and at somewhere between like 7 and 8 a.m., I think Bullard came out with some comments that were very hawkish. And I remember reading that and being like, this guy is signaling that this CPI number is going to come in light, because he's already trying to had some issues with audio again on 2 different PCs. I'm going to just mention that too. Sorry, there's been some issues in the VTF today. I'm just going to mention that again to these T3 Live people. Does anybody else have audio issues besides Mark at this point? Okay. Okay. I shot them a message. Hopefully everything's all good for tomorrow. The best bet always, guys, whenever you can't have sound, is always just do a quick restart of the VTF. You need to log off and log on the virtual trading floor every day in order for it to work properly. So for myself, when I turn the computer on the next day and my VTF room is still up and open, which it kind of sometimes is, I log off and log back on right away. It's the first thing I do, and then that limits me pretty much from ever having problems. Anyway, like I was saying, we have pretty much just seen hawkish commentary from the Fed nonstop. They don't want this market going up too much. It's exactly what we expected. And it was just a consistent repeat of it today. Like I said, the first Fed member who was using some hawkish language is coming out around 10 a.m. Let's actually analyze this price action a little bit better than just talking about when they were speaking. Because the rally off the open was very notable today. And honestly, the rally off the open threw me off. Because I was originally saying in the morning meeting, like, yeah, we're gapping down to the ADMA, but it's kind of just a day one gap, and usually after you've got 2-3 up days in a row, you need a couple of days of rest. We're gapping down just about to the ADMA, but I think what I said was we could easily trade down to 397.50 and still be bullish. We ended up obviously overshooting that. And I still think that we haven't broken any key downside levels that changes the picture. It's just a little bit of a deeper pullback than momentum bulls would want. I'll start becoming more concerned. Like the momentum bull spot that you don't really want to lose on a closing basis is like 395 for the SPYs. Today's low, by the way, is 395.11. And then the more major spots are this last pivot low, and then again the most major spot is that CPI at low. So for the most part, we're still above all of our major spots, but today was definitely a test for bulls. And if you get a repeat of today's action tomorrow and a much deeper price correction, it could spell trouble. You got your 21 EMA down to 391. So technically this equilibrium area here extends down to 391. It's not the end of the world on a deep bullish correction for us to come down to 391. That begins to coincide with where that last important pivot is, which is 390. You start really losing 390 in the market, that's when I think you got a bigger problem. And then of course the CPI low is a much bigger problem. But this is the last real pivot low of our downtrend. It's 390. The 21 EMA is above it. So really at this point, under no circumstance can bulls afford to lose 390. Today is a solid test for them, and a repeat of today tomorrow could be a big problem. So you want to see at least some degree of a snapback or attempted snapback, or breaking today's low tomorrow and then snapping back up intraday, something like that. You really want to see the bulls attempt to prove themselves to some degree tomorrow, because if we repeat this, we could be in big trouble. But for the moment, no major key levels have been broken. We're just kind of into that equilibrium area. That's the SPYs. Qs are weaker than the SPYs. They never got that higher high, but they also haven't broken down. You got your kind of clear support here, and the 21's at that about 280. That's your potential higher low that has not been confirmed by a higher high on the Qs. So 280, that daily level, 21 EMA is above it. Qs cannot afford to lose 280. They cannot have a repeat of today tomorrow. You really want to see bulls give some sort of snapback tomorrow. And then finally, this IWM, very concerning. Weakest, testing the 21, but still hasn't broken these lows. And they're kind of equal lows. The CPI day low and this pivot low, which is technically not a higher low because of the tail, but it's still closed above this day. So I'm going to call these roughly equal lows. The IWM cannot lose 180.50. So those are our real downside lines in the sand. So, for the moment, the short-term action is still bullish. But like I was saying in the morning meeting also, there's a bunch of things that we got to remember. And that's why while the short-term trend is bullish, I have to describe myself as cautiously optimistic. But caution, right? Caution in big yellow letters for a number of reasons. We got a 12% rally off lows here in the S&P. That coincides with our 2 other major bear market rallies of this year. That 12% rally comes right into this 200 day. And again, I am not a believer that support and resistance are defined by moving averages, but the 200 day in particular is a very powerful moving average, and where that moving average is really corresponds to this downtrend line that the market has been in from the very big picture. And we know that when you have competing trends, when you have a short-term uptrend, let's just say, and a large-term downtrend, not always, but the vast majority of the time, the large-term downtrend is going to win. By definition, one will have to win. You cannot continue to have a short-term uptrend and a large-term downtrend forever, right? Eventually, either the short-term uptrend just continues and continues, and it breaks your downtrend line on the big time frame, and it begins to reverse back up, or the opposite. Sorry, I'm distracted. Or the opposite happens where I'm just going to entirely repeat everything I just said because the background noise is just distracting me and I lost my train of thought. All right, when you have competing trends, when you've got a big picture downtrend that's competing with a small picture uptrend that cannot last forever, one of two things has to happen. Either the uptrend continues, it breaks this downtrend line, and eventually the big picture goes from being a pattern of lower highs and lower lows to a pattern of higher highs and higher lows. That's one scenario. Or the more likely scenario is the opposite. This uptrend eventually fails and the downtrend continues. That's always going to be the more likely scenario. Your larger time frame trends always have the higher probability of breaking. With that said, someday, I don't know if that's going to be this time around or if that's going to be over a year from now, there will eventually someday be a time where we are in a short-term uptrend and a large-term downtrend, and the short-term uptrend is actually the one that wins. It will happen eventually, but that's always the lower probability situation. And because it's the lower probability situation, and also because there's still a lot of macro headwinds that we got to be paying attention to, we should assume that the lower probability situation is not what's going to be what actually happens. We should assume that the higher probability situation will happen, which means that eventually this trend will break. Hasn't happened yet. It's still intact. We are still holding the key downside levels that are required in order for this uptrend to be there. But like I'm just saying, you repeat today, tomorrow, and then all of a sudden you're losing your short-term uptrend. So, and again, just because you lose a short-term uptrend does not necessarily mean we're making new lows on the year. It could just go from a situation where we have been, trending higher to just having sideways chop. And again, if you go back to Pat's note, I think it was JP Morgan was basically arguing for sideways chop until the CPI. I think the CPI is December 13th, but someone should fact check me on that. And that would make plenty of sense to me, honestly, if that's what ends up happening. But for the moment, we're still in this uptrend, and I'm still going to lean to the side of the longs. So it's what made today so tricky. It's like, we're gapping down to the ADMA. We could fall a little bit further and still be bullish. But this opening upside price action was kind of giving me a thought process of an all clear. Because whenever we have a large gap, and today was a large gap, right? We gapped down like 1%, maybe a little bit less than 1%, depending on which index that you're looking at. Whenever there's a large gap, what I always really want to see is how the market handles the gap on the 5-minute chart. And by how it handles it is the 8 EMA with the market, right? This same thing we were just looking at with the daily chart. The space between the 8 and 21 EMA is your small time frame equilibrium on in this case on a 5-minute chart. So when the market is opening up at 399 and your 8 EMA is opening up at 402, you got $3 of downside extension. That downside extension has to get satisfied, and there's a number of ways it can happen, right? You could go sideways here, let those moving averages catch up. That might take 30, 45 minutes. You could have a little bit of a bounce back, but also going sideways and kind of meet the market in the middle as it's coming down. You could even have initial downside momentum that eventually goes sideways or gives a little bit of a price correction for a lower high as those moving averages are catching up. And then you want to assess as it's happening, what a more bullish scenario is versus what a more bearish scenario is. Like for me, holding here and going sideways and letting the moving average catch up would always be like the most bearish scenario. And this is about as bullish as you can get. You get the big gap down on the day, followed by upside momentum coming into the market immediately, led by tech stocks, which is exactly what I was looking for. If you guys remember in the morning meeting today, what I was expecting was that energy could be weak. USO is gapping down really big. We also looked at Pat's note this morning that mentioned the spread between WTI and energy companies. I want to actually bring that chart up because I think it's a very telling chart. Here it is. So difference between the energy stocks and the WTI. This is kind of massive. And then on top of that, we've got this, really big gap down on the USO this morning. So what I'm thinking this morning is, hey, let's look at this XLE to see if we can have, some sort of, downside continuation here. So I'm like, and if that's happening, while TLT is gapping up and the UUP at that point was kind of flat to down small, maybe we can actually see a rotation day today where energy is weak and tech gets a little bit of a bid. And off the open this morning, it looked like I was just super spot on. Look at your first couple candles here from the XLE looking super weak versus what the Qs did. Qs just ripped off the open. First 3 bars, 3.5 bars, total gap fill, upside momentum coming in, led higher by Amazon on its Black Friday sales, led higher by Shopify, led higher by Etsy, basically those retail type of names. Even Apple, which I was super concerned about, was able to catch a little bit of a bid. The only one that was super weak this morning was Microsoft. For whatever reason, Microsoft was trading terribly right from the beginning of the day and working its way lower. So you got that going on, and you got energy being super weak. I'm like, okay, I might have something to work with. This is exciting to me on the long side of the market with this price action. The IWM was a concern though, and I pointed that out. And that was the first thing I noticed was, and how many times have we dealt with this very recently? I feel like the last few weeks have been full of this, where you can be looking at the Qs and it's like, all right, that's great. You can be looking at the SPYs and you're like, you know what, that's not bad. Those first few candles there, it's not bad. And you look at the IWM and you're like, wow, this one bar here is almost immediately negated by the next two, and that's at the same time as the Qs are still doing this. And what have we seen over and over and over again this calendar year is that the IWM, when it fails, the rest of the market fails. Over and over and over and over and over again, we've seen it. And today it happened too. There was a little bit of a glimmer of hope, I thought, at one point when we had a little bit of flip from relative strength to relative weakness. The IWM seemed like it started to improve versus the Qs at 10 a.m. for a brief period of time. And then everything just died. And a lot of that was led by the Fed members speaking. You got the first Fed member speaking around 10 a.m., making some not great comments. Then at noon, you had Bullard, who's just been such a consistent hawk for the most part, coming out and saying that, you know, the interest rates maybe need to get to that 5 to 7%, which the market really is not pricing in at this point. And then you had, you know, Williams speaking at 2 o'clock with more hawkish comments. It was just like one Fed member after the next kind of pushing this market down, and it really turned into an intraday downtrend day within the confines of the daily chart for the SPYs, which are still short-term bullish. So it makes for a tricky trading session because there was probably some opportunity to do some short selling today, and I actually was short, you know, Exxon for a period of time, though I got pushed out of the trade. But it's a hard trade because it's especially a hard trade because of how many afternoon rallies we've seen today, recently I should say. There's been a lot of days where we're seeing that opening weakness and then we rally back in the afternoon, and you can't count that out from happening as long as we're at least short-term bullish. So for me, it went from being kind of excited in the beginning of the day to once this market was losing its opening lows across the board, and once we had that real big negative Maribozu come in at 1020, just going, okay, this market had a chance. It failed for me. I don't necessarily want to be really pushing to the short side because the daily chart's still short-term bullish and we've seen so many afternoon rallies, but I can no longer be aggressive on the longs. And that's when I just, you know, totally, you know, put my foot off the gas pedal and, you know, here and there was trying maybe some extension type trades on the downside, but I had nothing else, you know, left to do on kind of a bigger picture. And I guess that's all I really got. You know, tried to short some Exxon. I got pushed out of that when new highs kind of came in. Traded a little bit of Microsoft on initially on this dip, and then I bought like 241, and I just liquidated my position above 242 into the close. Shopify, I also liquidated today into that big move, and I kind of bought back, but exited my position again into the close. I'll revisit it tomorrow. So, you know, again, kind of a nothing day for me. So that's all I got. Happy to turn it over to you guys for questions here. First thing I'm seeing is from Zach. How can we read the sweep action that Pat puts into the VTF to help us? Does it typically show very short-term action? Sure. So I don't want to say don't. I very, very rarely take a pure trade that's going to be entirely based on option flow. I view it's a layer of probability. So if I'm looking at a stock and I'm seeing a lot of bull flow coming in, and I'm thinking about getting long that name because of a specific trade reason, it's going to tell me that I have a higher probability of success. The opposite's true if I'm looking to go long a stock and it's just getting whacked and whacked and whacked and whacked by bear flow. As a matter of fact, I hate that. If I'm looking long a stock and I'm seeing a lot of bear flow come in, I probably won't even take the trade. That's how important of a layer of probability that is for us. Why is it a layer of probability? For a couple of reasons. One is it's showing us what the big players in the market are doing. You know, all of the data that we're always able to look at is always at least somewhat old, right? When we're like reading Pat's note and it's giving us data on, positioning or sentiment or things like that. That's like how positioning already was coming into the day. But that larger institutional order option flow that we see come into the market, that's orders that are going off like right now in this moment. It shows you what the big players are doing right now in this moment. And that's very notable. And what also makes it notable is just with an understanding of how market dynamics are working, especially when options are being utilized so much more now than they ever were. Options are a levered product, right? And if someone is coming in and they're just, buying a huge call order, making a really big bullish bet in the market, the people who are on the other side of that bet are typically going to be, sellers, are dealers, is what we kind of call them. They're also institutional, but they who are coming in on the other side of that, they're more like market makers who don't want to have outright risk. So if they're taking the other side of a really big bullish option bet that's coming in, so meaning that they're selling that position, then they're going to want to come in and actually buy the underlying stock in order to make sure that they're hedged and mitigate their actual risk. They don't want to have that type of exposure. So they're coming in and they're buying the stock. And in this type of market environment, when we've been dealing with such low liquidity, when these dealers are coming in to hedge themselves on that, it can actually create a really big move in that direction. And that's with these like gamma squeezes that were especially big in like 2020, 2021, when we were seeing all the big short squeezes. Like when Tesla was just, I'll never forget, like Tesla having that massive upside run that was just like the bullish option flow, like on some of these massive upside days here. Pat was just like all day, Tesla bullish action, Tesla bullish action, Tesla bullish action, Tesla bullish action. And there's a period of time, I don't know if it was ever corroborated or not, when they were saying that SoftBank had a trader that was coming in and was, I don't want to use the word manipulate the market because that's not the right term that should be used. But I can't really come up with a better term, where they were specifically understanding how these structured products work to come in to move the market by utilizing them in a certain way. So it just becomes a really important layer of probability for both of those reasons when you're seeing consistent flow come in. If it's one off and it's small, it doesn't necessarily mean too much to me. It's the consistency of the flow overall. And then it even affects the structure of like the S&P and the NASDAQ, like the indices, on just consistent broad flow. Like you'll see it all the time if you're paying really close attention to like the data that Pat is posting. Like you might be seeing like consistent bear flow as the market's in this downtrend, and then all of a sudden we see that flow flip, and that flow might flip like right as like a bottom is coming in. And then, now we went from seeing consistent bear flow as this market was working its way down. The flow flips. All of a sudden, the market stabilizes and it begins to work its way back up. So, it's become a pretty important piece of information that I'm paying attention to for my overall trading. And I definitely recommend that you're paying attention to it. But I wouldn't necessarily be like, oh, someone just bought something in Coke, bullish sweep just went through in Coke, so I'm going to, close my eyes and buy Coke stock. That's not going to be the move. It's about that consistency of flow in a particular stock, or the broad consistency of flow that you're seeing, or sometimes you want to pay attention to something that's just unusually large. It's incredible how accurate that stuff is, to be honest. It's like the market gravitates towards those levels all the time. So I hope that helps, Zachary. Question from Mark. Do you back test? I do not. If you do, how do you do it, or what tool do you use? I don't back test. I don't back test. The market environment's constantly changing. So you could do something and you could back test it, and those back tests all work perfectly, and then you implement it into the market and then it doesn't work. And part of the reason why I also just am not a general believer in back testing, I mean that's the real reason behind it. But even when I speak to these quantitative guys, Or, even when I speak to Sean Hendelman, who's the CEO of T3, Sean only trades with black boxes. He only trades with black boxes. And if you ask him about it, he doesn't back test, he forward tests. So basically what he does is he might have 100 strategies. And of those 100 strategies, maybe 8 of them or 10 of them are trading in a really big way, all at one period of time. And the other 90 of them are either trading live but small, just absorbing the data, or even on a demo account, but with real-time data, and then has a system in place to be able to like turn on and off the boxes based on performance. So even a person like that, who is about as high level of a black box trader as there is, doesn't do any back testing on his strategies or approaches, and doesn't believe in it. So I don't back test either, because the market environment, as Mark, you well know, is constantly changing. So if you could back test some strategies for the 2011 market, the 2010 market, and go, oh man, these strategies work great, and now you implement them here in 2022 just to find that they're losing every day. So I always want to be paying attention to what is the market environment right now, what strategies can pay me best for the market environment that I'm dealing with, and let me adjust towards those strategies. Good stuff here, scrolling through. What's up, Robert? How are you? I know you're not in the U.S., but I hope you had a happy Thanksgiving anyway. That makes sense. What's up, AM Trader? Good to see you, bud. From Ari Baba, I took your 10-20 candle advice and traded with that as a guide. Let me just remind myself on which. Oh, this 10-20. Yeah, we needed to recapture this high, and if we couldn't recapture that high, that's what I was saying at 10-20 to 10-30. We can't recapture this high. There is no reason to be looking to be bullish on the small time frame. If all 3 indices can get above this high, then we can start looking at our longs again. But while we're below it, and this is the importance, by the way, you guys hear me talk about negative Maribozus, the stock market's in the penalty box, the market's guilty until proven innocent. That's what this candle did at 10-20. Prior to 10-20, the IWM was a little bit of a scary warning signal here with the relative weakness. But prior to 10-20, you're looking at the SPYs, you're looking at the Qs, you could still be trying your longs. I think we called a QQQ long off of this low that you could have done. We called an Amazon long off of this low. I think Josh called out a Netflix long off of this low. Provided that the market is still innocent, that's the right thought process. But as soon as this candle comes in and we break this opening low and this negative Maribozu kind of comes in and that puts the market in guilty mode, it puts the market in the penalty box, we as traders need to recognize that longs just became significantly more difficult, and you either shouldn't be doing them or you should be extremely selective with what you're doing and less aggressive on the game planning for profitability. That's what you need to be looking for at this point. This market is now guilty, and maybe there can be like a downside extension trade. Like I remember Microsoft right here, right? Microsoft was the weakest stock of the day. They're trading terrible even when the Qs were bouncing. And the RSI, on the 5-minute, Pat was mentioning at one point was an 11, like it was, getting really, really oversold based on the way he looks at markets, based on the way that I look at markets, the space between where the 8 and 21 EMA is. You get this kind of hammer that comes in. Like you could have tried Microsoft long versus this low. I was actually bid a little bit lower. I was like really looking for extreme downside extension. I had a bid down in front of 242 just in case we just rip down to that for a little bit of a bounce. And even if you take that type of trade, once you're in that environment, that's a counter trend trade. That's a counter momentum trade. You need to then have a game plan that becomes much less greedy. And all of that is cued based off the market. The market tells us what to do. It tells us when we can be aggressive. Off the open, even if aggressiveness ends up failing, it was the right thing to do. To be thinking, okay, I got a market that is short time frame bullish. We have a gap down this morning into the ADMA. Look at this opening momentum. What's relatively strong? Let me get in some Shopify. Let me get in some Amazon. Let me get in some Netflix. Let me look at those trades. And then this candle then says, okay, market now is telling me that thought process is incorrect. I got my stop losses in. Let's let these trades play out. But I'm not looking to put on any real new long risk. I'm looking to take a step back and be very cautious and much less aggressive on my game plans. So I know that was more of a comment than a question there, Are You Baba? But I appreciate the comment because it allows us to review a good point on how everyone needs to be thinking about and approaching markets. From Mark here, question: for short-term scalpers, what win percentage would you consider an edge? Let's assume for this discussion it's a 1-to-1 risk-reward. I get the math component of it, but just curious in your point of view, I would think at least 60%. An interesting point for you, there are some weeks that can have a strategy hit 70%, but then like the past couple of weeks, the win percentage might be 40 to 50%. Granted, there was less volume and momentum. So the last comment there I think is important. You do want to make sure that the momentum trades that you're actually taking are within your edge on those types of trades. And again, market environments change, so at a certain point, like that might work better than others, or at a certain point, that trade might be there, but you might have to be significantly more selective about it. So I've never really traded with the 1-to-1 risk reward, but I know traders who do. I know traders who are, pure short-term scalpers and do trade, looking for 1-to-1 risk reward. And generally what I've always heard from them is 60% win rate or better. And that can still kind of give you a real edge there. I guess technically, if net of commissions, as long as you're able to have at least a 51% win rate, you will be making money in the long run. But I think that what you're looking for there to answer the question is 60%. And it, fine, 1 week it's 70%, 1 week it's 50%. That's 60%. It needs to be the totality of a longer period of time. But this question I think also goes back to market environments changing, what I was saying earlier about back testing versus not back testing. I don't think that if you have a strategy that really works for you, that you should ever really fully abandon it. You always want to keep that tool set. You want to keep that arsenal, but you want to pay attention to, am I in the market environment where that strategy is giving me a 70% win rate, or am I in the market environment where that strategy is giving me a 40 to 50% win rate? And then if it's that 40 to 50%, you need to be much more selective and do it much less and utilize other tools. And then when that market environment is having the conditions in such a way where you can be 70% win rate, making 1-to-1, then you become much more aggressive and increase the size on it again. From Dave, does anything stand out to you for SoFi making new lows today? It's a garbage stock. I really wish we would stop all talking about it every day. I don't know why we do. It's like one of the worst stocks you can find. It's a growth stock that's making 52-week lows when the market just had a 12% rally off of its low. Everyone who ever bought the stock ever in the history of the stock is out of the money. So they have plenty of stock to sell. The stock is extremely thick. It doesn't trade well. It gets thicker by the day because they do so much employee stock kind of compensation. It's extended to the downside. I still like the company, but it doesn't matter that I like the company. Look at the technicals. The technicals are complete and utter trash. What happens to SoFi if the stock market stops going up right now? This is what the stock market did after a good earnings report. This is what SoFi did after a good earnings report and the stock market went up 12%. What happens if the stock market goes down 10%? This thing's going to be like at $2. So there's nothing to think about with SoFi to the long side until it can prove itself technically. The stock came into today building on a bear flag, and it's so weak that you didn't even need the ADMA to catch up to highs in order for that bear flag to break down further. The thing is trash. Now, again, I think that the market is, my thought process is that the market is overpricing in the bearish scenario on SoFi, but that thought process is no reason to go long the stock. The market has some concerns about the regulatory stuff that they do with their crypto. I was reading about it over the weekend. They technically have 2 years to kind of exit or roll off their small crypto business, and it is a pretty small part of their business, and they're not supposed to increase their offering and what I've seen is their crypto offering has actually expanded recently, even if it's in a small way. That technically could be a violation for them. Was also, you know, reading some stuff about capital rules because they are technically a bank. So the thing that I like most about SoFi compared to like an Affirm or an Upstart is that they are a bank. But there's also problems that come with being a bank. You have to hold large amounts of capital, right? We see that all the time with the stress tests that the Fed does on like Citi and JP Morgan and Goldman and the real banks, if you will. Well, SoFi is a bank now too. They have to deal with that. And what their model is, it's an interesting model because it's very aggressive, and it could work for them in the right circumstances. And I'm not a banker, so I don't want to, speak ahead of myself. But basically, what they do when they take loans, a lot of the time when a bank like Wells Fargo issues a loan, a business loan or a mortgage loan or whatever, they immediately try to sell that loan out, or they put it into some sort of structured product and they sell out a basket of them or whatever. Obviously, we saw that brought the entire global economy down, 12, 13, 14 years ago, whatever that was now. But that's generally what they're trying to do, is they try to get the risk of the default of the loan off their books as fast as possible. SoFi doesn't do that. They try to use a loophole, and then again, the more loans I guess that you have on the book, the more amount of capital that you have to have in order to meet like the Fed stress tests and regulations and everything like that. But they try to exploit like a little bit of a loophole where if you hold the loan for less than 6 months, I think it is, or maybe less than a year, you don't have to meet the same capital standards that a like actual normal bank would have to in order to hold that loan. So what they try to do is they try to hold the loans for like 6 months, I think, to collect interest rates on it, but then flip the loan, then sell the loan before the regulatory requirements hit that cause them to have to hold more capital. Because holding more, there's a cost obviously to holding large amounts of capital to have that large loan book. So the concerns are economic concerns over the economy, that if the economy begins to deteriorate, they're not going to be able to do that aggressive thing that they've been doing, where they hold them for a period of time and then flip them, where they are either going to need to sell them right away and not collect those earlier payments that are coming in, just because that's when they can sell it, or if they're trying to hold it, then there becomes a risk as the economy deteriorates and the probability of loan default increases that they will get stuck holding it and then need to have all the extra capital to kind of make up for it. So that's a couple of things here that are really. Oh, and then obviously then the student loan stuff, right? The student loan moratorium getting increased again. That's their original business, which I still point to the fact that I think it's amazing that this company's been able to adjust so well that their initial business, the business that they started with, which is student loan refinancing, is literally dead, and that they've been able to do this well. It's still a short-term headwind, I think, the student loan stuff, but it that short-term headwind keeps getting increased and increased and increased. It's kind of ridiculous, actually, that, like, if you ask almost anybody, they would say that the pandemic is over at this point, and yet, for some reason, students still don't have to pay student loans. I don't get it. Nor do I get, by the way, student loan forgiveness up to $10,000 or $20,000 or whatever it is. It just makes no sense, especially in an environment where we're trying to decrease inflation. We're just gonna give out a whole lot of money. But yeah, so there's a lot of headwinds there for the stock fundamentally. I think that they're mainly short-term headwinds though, and there's a flip side to most of those headwinds. So I like the idea behind the stock, but the company's trash, so stay away from it. If it gets back over $6, we can look at it. It's at 445. It's all-time lows. The market just went up 12%. Let's stop talking about SoFi every day. No problem, Dave. Happy to help. From Sebastian, were you paying attention or planning to trade all the inside days we had on speculative names and others like Target and Pfizer? Yeah, Pfizer got brought up in the morning meeting today. I was looking at the inside days, specifically for like an Amazon for things that were relatively strong. I wanted to combine that inside as an execution, even though that Friday is that kind of BS half day with relative strength. So yeah, I was looking at some of them for sure. Bill K here giving us some info also for Zach's question. Dealers want to be delta neutral so they don't have directional exposure. Exactly what I was trying to say. And the term that he's heard is weaponized gamma. Yep, that's the term that I've heard as well. From Russell, this morning Paul G spoke about using the 15-minute rule. Can you break that down? Sure. So I missed Paul's comment about it, so I don't know exactly what he said, but I can tell you what my 15-minute rule is. My 15-minute rule is specifically in regards to swing trades. So a couple broad rules for swing trading. 1, swing stocks when you're in the money. If you're out of the money at the end of the day in which you put the position on, you should just close the position. Unless you have a specific game plan where it's a feeler position and you're willing to let it bleed against you a little bit. But really, if you put a trade on today, even if the intent is the big picture, the daily chart, you put that position on today, the position closes negative, you're down money on it at the end of the day, you should close the position because it's just too much risk. You're taking on all the risk of the stock gapping against you, the market gapping against you, the stock having bad news, the market trending down, just to try to make your money back for the most part. So generally, if we're keeping positions overnight even to begin with, we want to make sure that we have a profit cushion in order to do that. I call it my 1% rule. So before we get into the 15-minute rule, we can get into the 1% rule. The 1% rule, and it really should be a 1% guideline, and in a market like 2022 where volatility has increased so much, 1% might not be enough for a lot of names, but that's always what I called it. The 1% rule basically says I want to be at least 1% in the money on the position in order to keep it overnight. That way, if the whole market gaps down 1% tomorrow, like it did today, all I'm doing is giving back the money that I've already made. I'm holding the position overnight. There's inherently more risk in holding positions overnight, but I'm doing it from a win-win situation. What we want to avoid, the worst thing that can ever happen to you, you made a game plan. You know what you're risking on your game plan. You know where your stop loss is supposed to be. You're long, and your stop loss is supposed to be $50. And the next day, the market opens up at $49.50. You are now losing more than you planned on risking based on your game plan. That's a real problem. You want to do everything you can to mitigate that. So again, the best way to do that is to have a profit cushion of at least 1% in order to hold the position overnight. Now, with that said, as much as we try to take caution against stocks gapping past our stop loss and us losing more money than we game planned losing, in the market, anything that can happen will happen. Big gaps happen, overnight news happens, so it is possible that you have a 1% profit cushion, and the market gaps down, or that stock gaps down 3% the next day. That can happen. When a stock gaps past my stop loss is when the 15-minute rule comes into play. I will not, so I'm already losing more money than I planned on risking, right? At that point, I'm not going to liquidate the position in the first 15 minutes. I'm going to wait 15 minutes. I'm going to wait till 9:45 a.m. Eastern Time, and I'm going to put my stop loss in at whatever the low is at 9:45. I'm going to give it 15 minutes to breathe. I'm going to give it 15 minutes to shake out the weak hands. Because what you will see, and this rule has saved my butt actually on a lot of occasions, what you will see is sometimes if the market gaps down past your out, panic selling comes in that first 5-10 minutes. It puts in a pivot low, and that becomes the low of the day. The people who sold the second the market opens sold the low, and then it creates that pivot and it works its way back up. So my 15-minute rule is that if a swing position gaps past my stop loss, I wait till 9:45. I wait 15 minutes, which, just so you're aware, technically opens me up to 15 minutes of unlimited risk. But that's what I do. And then I put my stop loss in after 15 minutes at whatever the low is. Even if it's a penny above the low, the stop loss is in at that price. Hope that helps. Russell from Mark. Follow-up question. I think the answer is yes, but we have access to Black Box as well, and we could do the programming. Yep. There's a bunch of different options at T3 Trading Group for automated trading from a low level to an extremely high level.
What's up,
feel free to reach out to me offline if you ever need more data on that or you want the API guides. From Hemming. On Tesla. I was long Tesla at 215 versus the 210 low. Tesla was interestingly relatively strong today. At 215 versus the 210 low. Okay. I don't hate that. But the stock quickly hit the stop at 220 and then pivoted up really quickly. These things happen to me many times. Should I leave some gap for the stop order? And if so, how much? The answer is already no to that part of the question. Or should I not take this action? Any advice? So the only thing, and I know you've brought this up a couple of times now, and I appreciate you doing this, where you've brought up some trades in the afternoon meeting where it seems like you get shaken out and then the trade kind of works to a degree. The only thing that I would say is, so I like the information behind where you're buying. I still don't see the shorter term signal to buy. And I think that that's the difference maker. So like, what do I like about this trade? What I like about this trade is that Tesla was relatively strong today. Closed the day green. Not a lot of companies did that. It was one of the first to go green. It was way stronger than the Qs here. Traded really, really well. The market's bringing this thing down at 2 o'clock. It's becoming extended at about 2 o'clock. That's where you're looking at it. It's going back into like a gap fill here. So you have some like kind of gap fill support as it approaches kind of this unchanged area, unchanged territory as the market is just, it's just getting too extended. It's getting really extended to the downside. This is exactly where you should look for a long. But I still want to have that signal. What I really want to have is I want to have this type of a shape to a candle where the low actually came in at 220. Because you don't really have anything here on those first three candles, or you're talking about versus the 210 low. You don't really have anything at the 210 low that really truly signifies that this is a pivot, right? There's no like downside tail that kind of came in. There's no real kind of break higher. I see this candle and it gets a little bit above it on this one, so you could try it. But like I really want to have that extension kind of culminate in like a tail here that I'm going long, and then I'm putting that stop loss in like versus that tail, if that makes sense. And I do not like the idea of giving a random amount of space. If you're saying I'm going long off the 210 candle, then you're going long off the 210 candle. Now, if you wanted a larger stop, you could try to look for a larger stop, but the only larger stop would be the day low, and where you could be saying, look, this thing just pulled back to the gap fill. I think the market's due for a bounce. The market's been really weak today. Thing is back to unchanged. I understand that it, I don't want to get shaken out on volatility here. Where else can I use for a stop loss is this low, but now you got to take much less size in order to do that. So, depending on, how tight you want to keep your stop losses, you have to be like a surgeon on some of it. So I really think that the idea was right. The execution on it was a little bit tricky. I hope that helps. Mortgage-backed securities, yeah, fun stuff. Tate Olson, because it's going to print money in 10 years. I assume that you're referring to SoFi. No problem, Dave. All right, gang, 5 o'clock. Looks like we got through everything. I'm going to end the meeting today. Good stuff. Tricky day. I think that we navigated it really well. We focused on the right stuff up the open. Unfortunately, a lot of that failed because the market ended up being so weak, but we knew exactly what the right time was to take our foot off the gas pedal and then kind of go into wait and see mode. And tomorrow's another day, and we'll see how tomorrow, kind of gaps, and we'll come up with a game plan for it. So have a great night, everybody. I will see you all tomorrow.